Combined Motor Holdings has felt the pinch of a strained economy. The automotive group has reported an 8% decrease in annual earnings and a 12% fall in headline earnings. That's as it had to deal with an operating environment characterized by high interest rates and a weak currency. Given these challenges, CEO Jeb McIntosh says the results are creditable. A dividend of 220 cents per share has been declared. This is 8.3% lower than the previous period's payout. Goldfields has had a tough start to the year. The miner has posted a near 20% slump in production of the yellow metal during the period. That's as adverse weather conditions at some of its operations, such as Gruyere and Cerro Corona, put a dampener on output. And a fatal incident at South Deep also affected production. This weighed on all-in sustaining costs, which jumped 51% year on year. Despite the challenges experienced in the quarter, annual production and cost guidance for 2024 remains unchanged. Attacq plans to take full control of Mall of Africa. The Attacq Waterfall Investment Company has reached an agreement to acquire the remaining 20% stake in the asset. The move will cost just over 1 billion rand. The firm says the acquisition aligns with its intention of investing in precincts that it owns and controls. Mall of Africa anchors Waterfall City in Johannesburg and is currently the busiest mall in the country when viewed through the lens of mall visits. Core Potash plans to list on the A2X exchange. The Australian company will keep its listing on the JSE London Stock Exchange and the Australian Securities Exchange. The firm says the secondary listing on A2X will provide investors with an additional platform to transact and will increase the group's liquidity. Shares in the company will be available to trade on A2X on the 14th of May. Eskom has applied to the Johannesburg High Court for an order to force City Power to pay its debt, which stood at 1 billion rand at the end of March. The state-owned electricity company says the debt owed by City Power has worsened its already strained financial situation and threatens its ability to maintain essential infrastructure, invest in new technologies, and meet the growing energy demands of the province. A hearing on the matter is scheduled for June the 4th. Amazon has officially launched its South African unit to amazon.co.za. Until now, locals had the ability to access and use the company's main Amazon.com site. But with the recent development, consumers have the option of exploring a localized experience and goods from SA merchants. This means that Amazon now becomes direct competition for the likes of Naspers owned Takealot. Further afield, UBS has delivered upbeat earnings, logging its first quarterly profit since taking over fallen rival Credit Suisse. Let's take a look at this package report for more.
UBS scored its first profit since its takeover of Credit Suisse last June. Net profit for the January to March quarter came in at $1.8 billion, almost triple analyst forecasts. Analysts said the results were mainly driven by parts of the business inherited from Credit Suisse, for which UBS wants to exit, as well as by cost cutting. The banking giant said all operating divisions reported solid results. UBS also said it achieved a further $1 billion in gross cost savings in the first quarter. The results come just under a year since the merger of UBS with one-time rival Credit Suisse. The move was pushed by Swiss authorities who feared the scandal-hit Credit Suisse was on the verge of collapse. It was followed by 2 quarters of losses for UBS as it absorbed its rival. Despite that, investors have been upbeat about UBS's prospects given the low acquisition costs and its huge increase in assets. Shares in the bank have climbed some 40% over the past year. Investors were also happy with Tuesday's update, and UBS stock shot up more than 8%.
Now, shipping giant Maersk says that the ongoing disruptions of container shipping traffic in the Red Sea is increasing and is expected to reduce the industry capacity between the Far East and Europe by 15% to 20% in the second quarter. Let's hear more from our reporter, Anathi Ndevu.
Well, that's right, Zinati. The complexity of the situation in the Red Sea has intensified over the last few months. Now, the knock-on effects of the situation have included bottlenecks, as well as delays and equipment and capacity shortages. These, of course, resulting in additional time and extra costs for the shipping industry. Joining me now to provide more insight is Lars Halter from Deutsche Welle, who has the latest update. Lars, what's the latest on those disruptions?
Thanks for having me. The latest comes from Danish shipping giant Maersk, one of the biggest firms in the business, so big indeed with 730 container ships that it is widely seen as a bellwether for the industry. And they've just said that the ongoing disruption to container shipping traffic in the Red Sea is actually increasing and that it is expected to reduce the industry capacity between the Far East and Europe by 15 to 20% in the second quarter. Maersk says that it has diverted vessels around Africa's Cape of Good Hope since December. That is, of course, when Iran-aligned Houthi militants began attacking ships passing through the Bab al-Mandab Strait. That is the southern entry point into the Red Sea. And that strait is just about 20 kilometers wide at the narrowest point, giving rebels a relatively easy chance to attack ships passing by. And to avoid any such attacks, Maersk and other shipping companies were forced to reroute their ships around Africa.
Well, Lars, you mentioned that these disruptions have forced other ships to reroute around the Cape of Good Hope. However, the risk zone has, of course, expanded, with the attacks reaching further offshore, which, of course, have forced ships to lengthen their journey further. Maybe expand more on how these affect the rest of the world along the value chain, that is.
Well, this all ties into the Israel-Gaza conflict. The Houthi in Yemen, as I said, are aligned with and financially propped up by Iran, and Iran is, of course, Israel's arch enemy. So the Houthi involved themselves into the Middle East conflict by threatening vessels destined for Israeli ports. That included ships transporting containers of goods as well as oil and other freight. Now the Houthi managed to attack a few ships and even sink one, and that has led shipping companies to avoid the area, especially since some ships were attacked that were not heading for Israeli ports. And this is how it suddenly affected the rest of the world. The strait in question, as I said, leads into the Red Sea, which again leads into the Suez Canal. And that route is the shortest connection between the oil-rich Middle East or even the Far East countries to European ports. With ships now going around Africa instead of through the canal, they're extending their journey by about a month per trip. And that again has an impact on shipping costs, but also on the availability of vessels and containers. And those higher shipping costs are putting a burden on customers around the world. Again, no matter whether those customers are waiting on oil or gas deliveries, or whether it's industrial parts or consumer goods, high-tech bikes or toys, everything comes with slightly higher costs.
And I suppose no one knows the definite answer to this, but what is the outlook for the area and the disruptions?
Well, I don't think anyone can really predict today how long Israel's war in Gaza will continue, but most shipping experts have said that they expect disruptions to their business to last at least until the end of the year. And that means that all major shipping companies have made plans, and all of them include that longer trip around Africa. German shipping leader Hapag-Lloyd has warned that their higher expenses will impact their first quarter results. So has Switzerland's Kühne & Nagel, Taiwan's Yang Ming, as well as Italy's MSC, say they're not planning to ship through the Suez Canal until the conflict is resolved. And Hong Kong's OOCL shipping line says they won't even accept cargo to and from Israel until further notice. So pretty much anywhere you ask around the shipping industry, the response is the same. The outlook suffers, especially since no one knows how long the underlying conflict will go on.